Welcome, market participants, to another Three Things in Credit. I'm Van Hessler, Chief Market Strategist at KBRA. Each week, we bring you three things impacting credit markets that we think you should know about. Now, I don't have to remind you of all the twists and turns and take bombs we've witnessed of late, so I won't. I'll let Jim Reed, Deutsche's macro strategist, and I quote, "In nearly 31 years of doing this job, I've experienced many years dominated by huge headlines and crises, but I don't think I've ever seen the narrative shift so rapidly over such a short period. What is equally impressive is that most asset markets remain healthily positive for the year," unquote. So all is good, right? This week, our three things are: 1. Bond havens. The flight to quality has shifted. 2. Oracle Reassures. An AI lightning rod reports earnings and outlook. And 3. Risk Reprice. Where is it happening? All right, let's dig a bit deeper. Bond havens. We've long talked about the natural appeal of fixed income in an environment where stocks are priced for perfection in a decidedly imperfect world. FI's income and diversification attributes serve as ballast in portfolios, and the asset class's durability in that imperfect but not materially deteriorating world makes sense. That durability is tested by events unfolding in the Middle East. Ordinarily, we would expect developed world sovereign bonds to emerge as a haven in a geopolitical shock. Interestingly, that's not been the case this go-around. Since February 28th, the 10-year U.S. Treasury is out 32 basis points, UK gilts out 53 basis points, German Bunds 30 basis points, even the Swiss franc 21 basis points. Now, we suspect the moves reflect two things. 1, renewed fears of inflation. After all, war is inflationary. And 2, a higher risk premium reflecting tail risks of adverse outcomes. While it is debatable as to whether or not an oil shock is inflationary, we talked about this last week, we do worry about the prospects that energy prices could remain higher for longer and that higher inflation expectations could embed on the back of the shock. And sticky above target inflation is now the greater of risks to the Fed's dual mandate among what we believe is a majority, but not all, of FOMC members, meaning the magnitude of further monetary easing in 2026 has diminished from a little over 2 cuts now to a little over 1. Neither of those things, higher inflation and risk premium, in a vacuum are good for credit. The question then becomes, how is this affecting investor sentiment? And on that front, we got a pretty good indication this week as new issue credit markets have reopened with a vengeance. Amazon's massive $37 billion bond deal, priced on the back of a $126 billion book, that's second only in size to fellow hyperscaler Oracle's $129 billion demand for its $25 billion deal last month. Well, that Amazon deal is testament to investor demand for high-quality, less economically sensitive credit. Same can be said for defense contractor Honeywell Aerospace, which raised $16 billion. That book, 4 times oversubscribed, in its inaugural bond sale ahead of its planned spin-off later this year. Honeywell fits well into the halo category, heavy assets of low obsolescence now preferred by investors. Although to be fair, who knows how future wars will be fought? That discussion is for another day. Credit markets broadly have shrugged off much of what's been thrown at it lately, with spreads and Treasury volatility only marginally wider. That speaks to the relative appeal we talked about and a good enough for credit expectation of fundamental performance that figures to keep the asset class well bid for now. All right, on to our second thing. Oracle Reassures. Prominently among the things we're watching outlined in our quarterly Forward Look publication is AI promise. Obviously, there are many angles related to AI impacting risk markets. A transformational force that figures to test many businesses, ultimately instrumental in determining commercial winners and losers. A driver of economic growth not only through CapEx, but also wealth effect reliant on equity market support. For risk asset valuations to hold up at historically high valuations, the promise of AI has to be demonstrated and defined. Oracle's fiscal Q3 results this week were helpful in keeping the all-important promise of AI going. Demand for AI and advanced compute will continue to expand broadly across the economy, so says co-chief executive Clay Magorick on the company's earnings call this past week. The company reaffirmed 2026 guidance and boosted next year's top-line estimate to 4% above street consensus. Cloud revenue rose 41% year-over-year, and cloud infrastructure revenue jumped 81%. The company's backlog for its AI computing services, so-called remaining performance obligations, hit a whopping $553 billion, a remarkable 325% above the year-ago level. There were also signs the company is finding ways to turn its negative free cash flow around. Management said a combination of bring-your-own hardware and upfront customer payments enables us to continue expanding without any negative cash flow from Oracle. CapEx guidance is held at $50 billion in the current fiscal quarter, another positive sign that runaway CapEx is coming under control, allowing returns to build on that investment. Importantly, Oracle stock, one of the lightning rods for the AI story, has now bounced 19% off its recent low hit a month ago, keeping the promise of AI going. All right, on to our third thing, risk reprice. So for all the drama that the aforementioned Jim Reed referenced, where are we? The imperfect world we recognize features powerful crosscurrents. Flowing one way are above potential economic growth, double-digit corporate earnings growth, and low unemployment. Flowing the other way are little to no job growth, sticky above target inflation, price of oil spiking 60%, concerns over AI disruption, and elevated geopolitical tension. Well, that's a lot of uncertainty. How has the price of risk reacted? The S&P 500 at 21 times forward earnings is down from 23 times in October, but well above its 20-year average of 16.5 times. The VIX is 25, above its 20-year average of 19.5, but well below a 40 threshold, where we would typically see the fear gauge in times of heightened uncertainty. Credit spreads have widened, but only modestly, and remain well inside their long-term averages. So how do we read this? Well, for starters, all of those risk factors mentioned were known and taken into consideration prior to the events in the Middle East. What's new is the energy spike, where, among other interested parties, the U.S. consumer is exposed. Typically, you can factor in 25 cents a gallon for every $10 increase per barrel. This is going to hit the bottom prong on that K-shaped economy meaningfully, something that will only add to pressure on consumption. Remember that bottom 60% of household earners still account for a not insignificant 45% of total consumer spending. On top of this will be higher costs for energy-intensive industries, including trucking, airlines, petrochemicals and plastics, agriculture, and construction. Net risk has risen for risk assets. But how we view credit is not that simple. Start with an up-in-quality bias. That seems sensible in this environment. And that means demand for high-quality credit will increase as investors de-risk. So what we're looking at here is a bifurcation of the credit market. High-quality, durable stories in both public and private markets, secured and unsecured, will find plenty of demand with their dependable income and diversification benefits. More vulnerable stories and complex structures will see current pricing tested. So there you have it. 3 things in credit. 1. Bond havens. High-quality credit is in the spotlight. 2. Oracle Reassures. An AI lightning rod reports all the right things to keep the AI promise going. And 3. Risk reprice. In credit, a bifurcation is taking place. As always, thanks for joining. Don't forget to check in on kbra.com for our ratings reports and our latest research. We'll see you next week.